Okay, well, thank you, everyone. Glad to be here and glad to see everybody. Hope everybody's safe and well. In the previous sessions, we have covered a little bit about the economic outlook and then tried to tie that a little bit to what's going on in the financial markets. But more importantly, looking at what that really means for Main Street and all of us professionally going forward in terms of what we do and how we adapt to this new environment or this new normal. We're coming into this period now where we're going to be moving out of the COVID phase of the economy into a post-COVID phase. So I'll try to see if I can shed a little color on that and where we might be going, say, in the next 6 months. Also, in previous meetings, we've talked a little bit about some of the behaviors and those behaviors transforming what we do, how we work, remote work, what we're doing is stay-at-home behaviors, entertainment, health, education, and transportation. So this particular month is a different one because we just came into a new administration. There's a lot of change that's going to occur because of tax policy, fiscal monetary policy, and regulatory policy. So I'm going to try to see if I can shed a little light on that and discuss a little bit of what some of the implications are going to be. Okay, so this is a little bit of the numbers that we're looking at currently. The economy still continues to rebound from the low back in April. We're seeing projected fourth quarter GDP growth, 7.5%. Remember, that's kind of measuring from the bottom. Or actually from last quarter in this case. So we're continuing to see some continued growth despite the lockdowns and all the things that are preventing us from operating in a normal fashion. Obviously, the year-over-year rate is 33.4%, so it just shows you how far down we went and how far we've come back. So that's a good sign. The unemployment rate still remains at 6.7%. We're looking at a lot of people still out of work. I think the latest numbers on that is something like 10.7 million people are still unemployed. We've come back up, but we're still remain about somewhere around double the amount of unemployed before the pandemic started. So we have kind of a half-baked economy, as you know. Many of you are still kind of locked down or not able to work fully in your full capacity. So that's kind of the situation. The good side is that we've really adapted pretty well, many of us, to the new realities. And so the economy is kind of adjusting as we speak. And we're moving now, fast forward, into a new economy that is going to be pretty productive, I think, when we come out of this. So it could be very exciting for all of us as we emerge from this COVID phase into the post-COVID phase. Employment compensation up 2.4% year over year. That's telling us, despite the current situation with the employment situation, compensation has been going up. And that is a leading indicator of potential inflation. Labor costs are probably one of the biggest contributors to inflation. So we want to keep an eye on that. I know this doesn't seem to make sense, the minus 1.1% of personal income, but that's year over year, so don't take too much to that number. CPI rate still remains relatively low, 1.4%, but however, we're seeing some rising costs in food and energy. That's growing at a 3.9% annual rate, and we're also seeing some uptick in the energy costs. One of the things about that's interesting about what's happening is, the Fed, the government takes out typically the food and energy costs. So for many people, they're seeing rising costs, but, you don't see it in the CPI rate. And the reason is that they take those numbers out, food and energy. So this has a tendency to be what we call a regressive tax, particularly on people that, their main costs are food and energy and housing. So we'll talk a little bit about what we call the wealth gap, why that's widening a little bit because of what's going on with what some of the Fed's policies are. The Treasury note jumped up a little bit again this past month. We're up above 1%. Another indicator we want to keep an eye on because that's going to affect all kinds of financing costs, but it is also a sign of what Fed policy might be, where it might be going. If we continue to see that to rise, that is more indication of more inflation. Federal budget deficit, as we know, 3.3 trillion last year. Not a good sign. We're still growing the debt. Debt is over almost 28 trillion now on an aggregate level. So, when is this going to become a problem? Everybody asks. It's one of those things that isn't a problem till it is a problem. If the Fed can keep interest rates low, in some of the policies that they're using, you could probably sustain a higher debt without it causing an avalanche in some of the debt that's outstanding. We're also tied to world currencies, which is another barometer of what the current dollar should be and things like that. So it's a problem, but at the moment, I think with the current situation, we could probably tolerate a little bit higher debt and deficits. Most importantly, until we get out of the COVID pandemic. Consumer spending up 2.4% year over year. Consumers pretty engaged. A lot of people are doing a lot of home improvement. Things like beautifying their house and making it like their new entertainment center, since they're not going out to restaurants and other types of facilities. So it's kind of one of the things where we're seeing good indications in terms of growth, in terms of furniture sales, home improvement sales, and overall in things that are used in the home. Crude oil has bounded up again from the low, which is about $40 at the end of April, to $52. So we're seeing an uptick in that. However, there's some new policies coming out with the Biden administration. They just canceled the XL pipeline in up north in North Dakota and Canada. They also put a cap or a moratorium on new production in the Arctic. And there's more policies coming down that you will not be able to drill on federal land. So this is going to have wide ramifications on future production in the U.S. As you know, we were net energy exporters going forward. This has possible implications that we might see higher oil prices, because if we don't have enough supply, that has to come from somewhere overseas, and that could put pressure on a lot of different things on the dollar, among other things in terms of the economy. Good news, the Case-Shiller Home Index price went up 8.4%. We saw some really strong home sales in 2020, up about 5.6%. In 2019, as you probably realize, many of you, you could probably sell your house almost within a day or two, or maybe a week. Right now, housing prices in Orange County are at really all-time highs again. There isn't a lot of inventory, so we are seeing some positive developments in the housing market. That will also, have an impact on home improvement again. So we'll see a lot of those companies that supply products and services for upgrading the home, as well as new housing development, etc., should do well going forward. That's also evidence in the residential fixed investment number, which is a good number because that definitely translates into better GDP. As part of a real core component of the GDP number that we track. Gold futures are kind of hanging around. While we may be seeing a little bit more inflation, the price of metals is pretty well stuck around a trading range, so nothing new there. Copper futures were up a bit in the past couple of months, but kind of flat in the last month, so nothing significant there, although we will probably see some more pressure on commodities, particularly things that use for home sales, as well as maybe EV sales, which copper is also involved in. The dollar is continuing to kind of trade down a little bit, not precipitously, but it's a gradual grind down, and this is one to keep an eye on. This the dollar has a big impact on everything, particularly on what people perceive about interest rates, debt. If the U.S. dollar continues to fall, then naturally foreigners are going to want to get more interest because the value in the dollar is going to be less. It also translates to higher cost in energy, so we'll want to keep an eye on the dollar as we go forward. And then new orders for durable goods. We don't have the latest number, but that continues to grow. Okay, so let's shift into a little bit of some of the policies coming up here. We've had a sea change here in the last month with the election about policy and everything from monetary, fiscal, tax, and regulatory. The number one thing that I think everybody's worried about, which is kind of front and center, is COVID. And when are we going to get out of this? When are we going to get out of the lockdown? And when are we going to get back to working again and getting back to normal? So the Biden administration has three initiatives that they're working on right now. One is to use every capacity that they have within the government, the Defense Production Act, to increase the possibilities for getting vaccines and anything else that could be used to get us back to working again and get people vaccinated. So in the last couple of days, they just announced a 16% increase in vaccine production. They're going to award they put an order for another 100 million vaccines from Pfizer and another 100 million vaccines from Moderna. So we're going up from 600 million from 400 million in terms of total expected doses to be available to U.S. Citizens. There are also the new fiscal policy or monetary policy of the Biden administration is proposing a $1.9 trillion aid package that includes 1,400 stimulus payments to individuals, expanded jobless payments and benefits, paid work leave, aid for schools, and hard-hit small businesses, and a national vaccine program. The PPP program, the Paycheck Protection Program, was relaunched in January. There's about 60,000 new borrowers, obtaining about $5 billion in new forgivable loans. There's a lot going on there, by the way. Talk to your tax accountants. There's a lot of forgiveness available to everybody, particularly small business owners. There's a lot of tax credits for leave because of COVID-related illness, family leave, etc., etc. It's way beyond what we could cover here. It might be something you might want to have Bill get a CPA to talk about this, because this is going to be big for taxes, and it has a lot of bennies in there, particularly for the self-employed group of people. Okay, so those are the major ones there. Total aid, just so you know, on the average PPP loan size was $20,000 for first-time borrowers, $75,000 for second-time borrowers. That was through January 17th. Like I said, there's a lot of forgiveness there. So if you have employees, you really need to get your arms around this, because there's a lot of potential possibilities for you to get forgiveness of debt here, and it's big. So talk to your tax accountants to find out what's out there. Okay, I'm just going to run through some of the tax provisions real quick. Some of the proposals, this is going to be not good necessarily for us business owners as well as for individuals. There's a lot of things in here that are restrictive and may actually curtail growth. So I'll just run through them real quick. On the individual income tax rates, they're talking about increasing the tax rate, elimination of the capital gains tax preference. We're looking at potentially higher capital gains tax rates for people earning over $400,000. The removal of the Section 199, if you're familiar with that, that was a deduction that you could take about a 20% deduction if you were a business owner against income. They're talking about removing that, which is not going to be good. Capital gains tax benefit itemized deductions capped at 28%, and a reduction of itemized deductions by 3% for income above $400,000. Also, if you're familiar, that there was a cap on Social Security tax, about $142,800. Now they're talking about uncapping that if you earn income over $400,000. and they're going to continue to go ahead and try to see if they could increase the amount of Social Security coming in from all wage earners. This has generally not been well received in the Senate and in Congress, so I'm not sure this is going to go through, but they're talking about it. Retirement accounts, there's a whole set of changes on what the deductions are going to be. Maybe it's going to be a credit, not enough information about that, but there's going to be some changes on how you might be able to deduct your IRA contributions, your 401k contributions, and 403b contributions. Okay, business tax proposals. The federal corporate tax rate going up from 21 to 28. A new alternative minimum corporate tax on profits for some companies of more than 100 million of profits. A new surtax in corporations that do offshore manufacturing. So if you're doing things like that, you need to consider that. And also benefit for making things in America, a tax credit of 10%. Potentially that might be in the forthcoming. Some sector proposals. Let's see, the main ones I think to consider here. They're talking about elimination of certain preferences for fossil fuels. Many people might think that's probably necessary anyway. But the biggie here, if you're in the real estate business, and this is going to be a real gotcha if they put this through, they're talking about eliminating the 1031 like-kind exchange. That has really big implications for the housing market, and also the ability to offset real estate losses against other income under passive activity losses. There's going to be a big fight about this because if this goes through, you probably have some big implications on what the value of real estate is going to be going forward. Okay, just a couple of quick other ones. Elimination of the step up in death. This is a huge one. They're talking about getting rid of, on the death of an individual in a community property state like California, essentially you get the full step up in basis on any not what we call non-qualified assets. So those would be like, things in your home, your stock investments that are not in your retirement accounts. If they eliminate that, you're talking about a whole lot more of potential capital gains taxes forthcoming. So this is a big deal. And then they're just talking about changing the estate and gift tax, maximums for the transfer of estate tax-free. Okay, so let's move into the markets real quick and then turn it back to you guys. Okay, so just a quick synopsis of where we are. We're again near all-time highs. The Dow up at 3937 as of yesterday. S&P 3849, NASDAQ 12850. The markets are doing well, and there's a lot of discussion about this. Will they do well going forward under a potential administration that has a lot more restrictive monetary, or I should say tax regulatory policy? With the forward P at 22, that's close to being at the historic highs. So what might be reasons why the market would still do well? Well, one of the big reasons is monetary policy. The Biden administration is proposing this $1.9 trillion stimulus package. There's supposedly another package coming not far behind it with another $2 trillion. So if you add those two up, say about $4 trillion, you're looking about potentially something like 20% of the economy in terms of stimulus. So that money flows into the economy in a number of ways. One is new loans that are authorized at very low interest rates, and that increases what we call the money supply. And the money supply then affects the ability of people to spend more, puts more money in, available money for loans, but also some of that money trickles into the stock market in a couple of ways. People save it, decide they don't want to spend it because they're worried about the future, so they put that in the stock market. The other thing is if they do spend it, it increases current revenues and profits, so the stock market benefits from that. So while there might be more restrictive tax policy and regulatory policy, there is also this policy of monetary policy that might provide the additional stimulus that'll fuel the markets. So what we're also seeing is on here is if you look at the profit margin, this is a very high number, 10%. That's historically at one of the highest numbers And, as long as that stays high and we don't have a profit squeeze because of inflationary or tax policy, that's good news for the market as well. We're also seeing record numbers in terms of the number of companies above estimates at 86%, revenues 82% above estimates. This again is good news for corporate America. Companies are adapting to the COVID realities and making changes. We're seeing huge changes just alone in e-commerce, which I'll show you a quick slide. Healthcare is doing very well because of what the COVID pandemic has caused. So huge investment going in healthcare, Operation Warp Speed. Major changes going on in drug discovery, healthcare delivery, which we wanted to talk about today, but we'll have to cover that in maybe a future meeting. Very exciting stuff going on in the healthcare segment. Technology, a huge weighting with 27% major investment going into cloud, connected TV. Everything's more or less remote at this point. So that's how we're all able to operate, actually, if we're looking at what we're on the Zoom call. The amount of infrastructure that's being put in place is going to have major benefits in production as we emerge out of COVID. And then as energy, we discussed, kind of hanging in there at $52.52. One last slide I'll share with you just about what's happening with sales and retail sales. Again, retail and consumer spending accounts for about 70% of the economy. So the fact that we see retail doing well overall during the 75 days of Christmas, 3% growth is good news. The big news, though, is e-commerce, 49% of sales growth. This is huge when you look at what's going on with some of the companies in that space and your behaviors of what you're doing on a daily basis with your home investment and with your business investment. We're seeing major transformation here, huge winnings, huge structural change in the economy in terms of how we do things, which is just a symptom of where we're going in the future. Many people, just in summary, has said that what we are experiencing now is we fast forwarded 3 years into the future with spending or with change in terms of our habits. So we would be there maybe 3 years from now, but because of COVID, we had to adapt very quickly, which is amazing when you think about what's happened, how we have done, what we've done to adapt to this change, and how we still have hung in there financially as well as in the investment markets, etc. So that's my summary of ideas. Any questions, or turn it back to you, Bill? Well, Jerome Powell I guess, he's finishing up and Janet Yellen just took over. So basically, both of them have said that they want to have accommodative monetary policy, most likely through at least 2022 and maybe into 2023. So that policy statement hasn't changed in any significance, and they're actually talking about letting the economy burn a little hotter. They have a 2% inflation target as a policy objective, but reality is we're get closer and closer to that as we speak. Many think that they're going to just let the economy burn a little bit hotter this year. So we'll probably see continuing low interest rates through 2021 for sure. And that is just having dramatic effect on everything we do in terms of how we, buy homes. If you've looked at interest rates on home mortgage rates, car loans, but also on the financial markets. If you have 0% interest rates or very low interest rates, there really is no real place to put your money in the fixed income asset class. So that money is being forced into what we call long duration assets like real estate and the stock market. So it bodes well for those things. What the problem with it is, when you really just to summarize it, it has an effect on what we call the wealth gap, that the rich are getting richer because if you have real estate assets or stock assets, those are going to appreciate. But if you're a wage earner stuck in some kind of ordinary job, your wages are going to be somewhat stagnant. And so you don't really have that capital to invest. And so these are some of the political, things that we're dealing with, that we're seeing a growing divide between the haves and the have-nots.